Let's uncover some of the essential strategies to slash your crypto tax bill. Nobody likes paying taxes, especially on hard-earned crypto gains. What if you could keep more of your profits by being strategic with your crypto taxes? In the next few minutes, I'll break down the essential strategies to help you slash your crypto tax bill. We're talking about simple, actionable tips that can make a real difference in your pocket. It doesn't matter if whether you're a seasoned crypto trader or just starting out. Firstly, understanding capital gains, short-term versus long-term. This is a fundamental concept that every investor should grasp. Before we get into the strategies, let's make sure we're all on the same page about capital gains taxes. These taxes can significantly impact your net profits, so understanding them is crucial. Whenever you sell an asset like cryptocurrency for a profit, you're subject to capital gains taxes. This applies to all types of assets, including stocks, real estate, and of course cryptocurrencies. The amount of tax you pay depends on how long you've held the asset. The holding period is a key factor in determining your tax rate. If you hold an asset for 1 year or less before selling, any realized profit is considered a short-term capital gain and taxed at your ordinary income tax rate. These tax rates can vary and is based on your income bracket. For some, this could mean paying up to 37% in taxes on their short-term gains. If you hold an asset for more than 1 year before selling, any profit is considered a long-term capital gain and taxed at a lower rate. This is where strategic planning can make a big difference. That difference in tax rates can really add up over time, especially with significant gains in the crypto market. Long-term capital gains rates are generally much lower, often maxing out at 20%. Wouldn't you rather pay less taxes on your crypto profits? The choice seems obvious, but it requires patience and planning. The lower rates allow you to keep more of your hard-earned profits, which can then be reinvested or used for other financial goals. We're not talking about avoiding taxes altogether. That's neither legal nor ethical. Instead, we're focusing on minimizing your tax liability through smart investment strategies. This involves understanding the tax implications of your investment decisions and planning accordingly. Understanding the difference between short-term and long-term capital gains is crucial. For example, if you bought $10,000 worth of Bitcoin and sold it a year later for $20,000, that's a $10,000 profit. But how long you held that Bitcoin also determines how much tax you'll pay. If you held it for less than a year, you'd be taxed at your ordinary income tax rate. This could significantly reduce your net profit. But if you held it for more than a year, you'd qualify for the more favorable long-term capital gains rates. Now we are going to shift to tax loss harvesting. We've talked about the benefits of long-term holding, but what about when your crypto investments lose value? It's a scenario many investors face in the world of cryptocurrencies. That's where tax loss harvesting comes in. This strategy can help you turn those losses into potential tax savings. This is a strategy where you sell investments that have gone down in value to offset any capital gains you might have realized during the year. This can be particularly useful if you've had a mix of winning and losing investments. By realizing those losses, you can reduce your overall tax liability. This means you might owe less in taxes or even get a bigger refund. Unlike stocks, cryptocurrencies don't fall under the wash sale rule. This rule typically prevents investors from claiming a tax deduction on a security sold in a wash sale. This means you can sell and buy back similar assets without being penalized. You can maintain your investment position while still benefiting from the tax deduction. For example, if you bought Ethereum at $4,000 and it's now down to $3,000, you could sell that Ethereum to realize a $1,000 loss and then immediately buy back in at the lower price. This allows you to stay invested while also taking advantage of the tax benefits. Your overall position in Ethereum would not be affected, but it would allow you to claim that $1,000 loss on your taxes. This can be a smart move to manage your tax obligations. Tax loss harvesting isn't about trying to time the market perfectly. It's about making strategic decisions that can benefit you in the long run. It's about strategically using the tax code to your advantage. Understanding these rules can help you make more informed decisions about your investments. In the world of crypto, where volatility is the norm, tax loss harvesting can be an especially powerful tool. The frequent ups and downs in the market provide numerous opportunities to implement this strategy. On to the next one, the power of long-term holding. Let's dive deeper into the power of long-term holding. This strategy is not just about waiting, it's about understanding the market and making informed decisions. Holding on to your crypto investments for the long haul can make a world of difference when it comes to your taxes. The longer you hold, the more you stand to gain. Owning an asset for more than a year qualifies you for long-term capital gains tax rates, which are significantly lower than short-term rates. This can result in substantial savings. But the benefits of long-term holding go beyond just tax savings. It's also about the potential for greater returns as your investments mature. When you hold for the long term, you're riding out the volatility that's inherent in the crypto market. This means you're less likely to be affected by short-term market swings. You're not making impulsive decisions based on short-term price fluctuations. Instead, you're focusing on the bigger picture and long-term growth. It's a more strategic, measured approach. This involves regular reviews and adjustments to ensure your investments align with your long-term goals. Think of it like sailing a boat across a choppy lake. If you're constantly adjusting your sails based on every gust of wind, you're going to have a bumpy ride. But if you set your course and make adjustments gradually, you'll navigate the rough waters more smoothly. This steady approach helps you stay on track. Long-term holding is like setting your course and staying the course. It requires discipline and patience, but the rewards can be significant. It allows you to weather the storms of volatility and come out ahead in the long run. By staying the course, you can achieve your financial goals. And when you factor in the tax advantages, it becomes an even more compelling strategy. Lower tax rates mean more of your gains stay in your pocket. Stay informed about the market, monitor your investments, and make adjustments to your portfolio as needed. This proactive approach ensures that you are always aligned with your financial objectives. Remember, patience pays off. By holding your investments for the long term, you position yourself for success and financial growth. Next, grow your crypto in a tax shelter with a crypto IRA. Let's talk about a powerful strategy that can potentially supercharge your crypto investing. The crypto IRA. If you're in the US, a crypto IRA allows you to invest in cryptocurrencies within a tax-advantaged account. This means you can potentially grow your crypto holdings tax-free or tax-deferred, depending on the type of IRA you choose. There are two main types of crypto IRAs, traditional and Roth. With a traditional crypto IRA, your contributions are tax-deductible in the year you make them, and your earnings grow tax-deferred until you withdraw them in retirement. With a Roth crypto IRA, your contributions aren't tax-deductible, but your earnings grow tax-free, and you can withdraw them tax-free in retirement. Setting up a crypto IRA is different from opening a regular IRA. You'll need to find a custodian that specializes in crypto IRAs. Some popular options include iTrust Capital and Bitcoin IRA. These custodians provide a platform for you to buy, sell, and hold cryptocurrencies within your IRA. This strategy can be a powerful way to grow your crypto holdings tax-free or tax-deferred. Moving on, here's a strategy that helps you save on taxes and make a positive impact. Donating cryptocurrency to charity? When you donate to a qualified charity, you can potentially avoid paying capital gains taxes on the appreciated value. Plus, you can often claim a tax deduction for the full fair market value of the donated crypto. For example, if you bought $1,000 worth of Bitcoin a few years ago, and it's now worth $10,000, you could donate that Bitcoin directly to a qualified charity, and you wouldn't owe any capital gains taxes on the $9,000 appreciation. Not all charities are equipped to accept cryptocurrency donations, so do your research. Some platforms, such as the Giving Block and Fidelity Charitable, make it easy to donate crypto to a wide range of charities. Donating cryptocurrency to charity is a win-win situation. You get to support causes you care about while potentially reducing your tax liability. Remember, the crypto landscape is constantly evolving. Tax laws vary from country to country. Always stay informed. Do your own research and consider consulting with a qualified tax professional if you're unsure about your next steps. So there you have it, a few essential strategies to slash your crypto tax bill and keep more of your hard-earned profits. Whether it's tax loss harvesting, leveraging long-term gains, or setting up a crypto IRA, taking action today can make a huge difference. If you found this video helpful, don't forget to like and subscribe for more crypto insights. Thanks for watching, and see you in the next video.